$3.7 billion for a Japanese glass maker. Tell me again how private equity is dead.
It isn't dead, it just moved to Tokyo. Apollo buying Nippon Sheet Glass is exactly what happens when U.S. dealmakers panic over domestic tariffs.
Oh, please. They aren't running from tariffs, Nate. They're running toward a cheap yen. Outbound M&A spiked 155% because Japan is basically on clearance right now.
Clearance rack or not, buyers are heavily sweating the supply chain checks. Let's see if Apollo actually read the fine print on this one. The rundown.
$1.1 billion for the retina business. Just the retina piece of EyeSouth. Cencora isn't messing around.
Olympus Partners has to be thrilled with that exit. Carve-outs are practically a love language for healthcare bankers right now. You buy the whole clinic network, polish up the highest margin specialty, and flip it to a strategic buyer for 10 figures. Beautiful.
Speaking of 10 figures, Gilead is writing a nearly $2 billion check for Ouro Medicines. They really want to bolster that autoimmune pipeline.
Big Pharma is treating the inflammation space like an all-you-can-eat buffet. It really feels like the exuberance is completely back. Goldman Sachs is already projecting a massive surge in deal activity through 2026, pointing to easing monetary policy and all that AI capital investment. We hit 1.1 trillion in volume, Maya. The floodgates are officially open.
Okay, stop right there. You're sounding way too much like a sell-side pitch deck right now. KPMG literally just put out a note saying buyers are operating with meaningful restraint.
Oh, come on. 1.1 trillion is not restraint. That's a shopping spree.
It's a highly scrutinized shopping spree. Talk to any deal lawyer right now. Due diligence is an absolute nightmare. Buyers are dragging out timelines just to interrogate targets over tariff exposure and revenue concentration. They're terrified of shifting trade policies.
Fair point. I'm hearing the exact same whispers about the perfect corp deal. They just formed a special committee to evaluate a going private proposal, and the diligence requests behind closed doors are reportedly brutal.
Exactly. Nobody's buying blind anymore, which is why I actually love what Vertiv is doing. They just bought ThermoKey.
Ah, yes, the glamorous world of heat rejection specialists.
Don't mock the heat rejection. AI data centers run hot, Nate. It's an incredibly smart, unsexy infrastructure play. Just like Veolia spending 220 million Aussie dollars to buy up a soil remediation player down in Australia.
You always fall in love with the dirt and pipe steals. Cleaning up forever chemicals is good business, I'll give you that. But you know what else is good business?
Making a $3.7 billion bet on Japanese glass.
Bingo. Apollo is making a massive swing overseas, and the structure of this buyout is fascinating. The big one. I just love the mental image of a bunch of Apollo guys in quarter zips suddenly caring deeply about architectural glass manufacturing in Tokyo.
Hey, for $3.7 billion, you learn to love whatever material they put in front of you.
Fair. But Nippon Sheet Glass, this is classic Apollo. They find an old-school, capital-intensive industrial play, completely ignore the sexy tech narratives everyone else is chasing, and just quietly buy the whole thing.
It is not just Apollo, though. Outbound US M&A spiked 155% last month. Everybody is looking overseas right now.
Because the dollar is strong and US valuations are giving everyone a nosebleed. You look at Japan right now. Corporate governance is finally reforming. The yen is cheap. It is an absolute playground for private equity.
I am not buying the easy money narrative here. I read the KPMG report on this $1.1 trillion market rebound. They specifically use the phrase meaningful restraint. Buyers are actually terrified.
Terrified is a very strong word for writing a $3.7 billion check.
I mean it. The due diligence periods are dragging out forever right now. Industry experts are saying buyers are putting targets through the ringer over tariff exposure and revenue concentration. You are buying a massive heavy glass manufacturer with global supply chains right when trade policies are shifting globally. The risk profile on this is absolutely huge.
But that is exactly why Apollo is the buyer. They priced that risk in. They probably modeled out every single tariff permutation before they even signed the NDA. They love complexity.
Modeling tariff permutations in Excel and actually surviving a trade war are two very different things, Nate. I want to see how they handle the physical supply chain bottlenecks.
Look, I think Apollo sees a clear path to value creation here. They're going to shatter the old management structure, optimize the operations.
Wait, did you just say shatter?
I did. It was right there.
You are literally incapable of not making a terrible banker pun. You sound like a sell-side pitch deck from 2006.
The puns are free, Maya. They add alpha. But seriously, Goldman Sachs thinks this is just the warm-up. They are calling for a massive M&A surge in 2026. They cite easing monetary policy, the AI capital boom, and a much softer regulatory environment.
Yeah, but notice they pushed that prediction to 2026, not this year. The tariff anxiety is real. Buyers are scrutinizing business durability like never before.
It makes sense. You do not want to buy a company today and find out next month that your entire margin was wiped out by a new import tax.
Exactly. And speaking of people hiding things in the due diligence room, we need to talk about what is happening with Perfect Corp. They just formed a special committee for a take-private deal, and the board is acting very strange about it. Voices.
Goldman is already calling it. They just put out a note saying 2026 is going to be an absolute monster year for M&A, easing rates, relaxed regulation, and just a tidal wave of AI capital investment.
I read that note, and honestly, it feels a little like they are just trying to will a mega cycle into existence so they can collect the advisory fees.
Oh, come on. The macro setup is practically gift-wrapped right now. You have to admit the floodgates are creaking.
I will admit the volume is up, but compare Goldman's victory lap to what KPMG just put out. KPMG acknowledges the $1.1 trillion rebound, but they specifically use the phrase meaningful restraint. Buyers are not exuberant, they are sweating.
Meaningful restraint. That is just banker speak for we want to buy things. But our credit committee keeps asking annoying questions.
They should be asking questions. The industry experts are seeing due diligence drag on for months right now. Buyers are interrogating targets over revenue concentration and specifically tariff exposure. Nobody wants to buy a physical supply chain that gets taxed to death by next quarter.
The tariff panic is very real. I heard dealmakers are completely pausing some cross-border industrials just to model out trade policy shifts. But you know what sector doesn't care about shipping containers and tariffs?
Software.
Exactly, which is probably why Perfect Corp is suddenly the center of all this buyout chatter. Their board just formed a special committee to evaluate a going private proposal.
Right. That non-binding offer that came in earlier this month. They are keeping the actual backers entirely out of the filings for now. Typical.
Oh, they are keeping it locked down tight. But cash-rich tech giants are still hunting for strategic bolt-ons, and AI software is where the money is flowing.
I am extremely curious to see the pricing on the Perfect Corp deal once the disclosures actually drop. If that KPMG restraint narrative holds, nobody is paying a massive premium.
We might get those details in the morning, which rolls us right into what we are watching for tomorrow. Spill the tea. I'm telling you, the Perfect Corp take private is happening. You don't form a special committee for a preliminary, non-binding proposal unless you already know exactly who's writing the check.
I completely disagree. Non-binding is just banker speak for we had a coffee and floated a number. They formed the committee because they have to. Fiduciary duty and all that. Have you looked at how long due diligence is taking across the board right now?
Forever? But that's just because buyers are looking for any excuse to shave a few million off the top. It's standard tire kicking.
No, it's the tariff exposure. Dealmakers are absolutely sweating over shifting trade policies behind closed doors. They're dragging out diligence to interrogate targets over every single supply chain link.
Okay, fair. I remember making an analyst pull an all-nighter just to check shipping receipts, but Goldman Sachs is still predicting a massive M&A surge through 2026. They're citing easing monetary policy and a better regulatory environment.
Sure, Goldman is cheerleading. Shocking. But look at the KPMG data. We hit a $1.1 trillion rebound in deal volume, but buyers are showing, quote, meaningful restraint, unquote. Translation? Nobody wants to catch a falling knife if tariffs blow up their margins.
Meaningful restraint? What a beautiful, polite way to say private equity is terrified.
Exactly. So, until Perfect Corp actually names their backer and a real price, I'm treating this as pure corporate theater.
We'll see who's right when the committee finally discloses the details. But speaking of buyers who are definitely not showing restraint right now, we need to talk about what cash-rich tech giants are doing.
Oh, absolutely. Over 170 billion in software and AI deals recently. We should look at who is next on their bolt-on shopping list. Nippon Sheet Glass. Tomorrow's radar.
I'm telling you, Goldman is right. They're calling a massive M&A surge for 2026. With tech giants sitting on endless cash, we're going to see a feeding frenzy in AI bolt-ons.
You're buying the Goldman hype again. KPMG just said buyers are showing meaningful restraint. Did you miss the part where due diligence is taking twice as long?
Restraint is just banker speak for waiting on rate cuts. The software sector just did 170 billion in deal value. That isn't restraint.
It is when buyers are suddenly interrogating targets over tariff exposure. Dealmakers are sweating these trade policy shifts behind closed doors. You know how much you hated prolonged due diligence.
Don't remind me. I still have nightmares about verifying international supply chain receipts from a decade ago.
Exactly. So keep an eye on Perfect Corp tomorrow. Their special committee should be dropping more disclosures on that going private proposal.
Assuming the committee actually agrees on who is paying for it.
A massive assumption. We'll be right here to read the footnotes when they do.